Hey everybody, Abdullah Shamari here with you. Today we'll be going over all things SPAC related. We'll be going over 4 different things. One, we'll be explaining how SPACs work, how are they formed, and what the structure of a SPAC looks like. 2, we'll be walking through the timeline of a SPAC from the initial onset of the SPAC all the way through a merger being announced, and then what the process is like all the way until the reverse merger occurs and the 2 companies join. 3, we'll be going over why SPACs are a good investment opportunity, how they're low risk and potentially high reward investments. And finally, we'll be giving some recommendations of SPACs that I have on my watch list. You'll need to do some further analysis on your own, and we'll also present some further analysis on this page at a future time. But I wanted to give out the information briefly at this point so you all have the needed information and you can start doing your own due diligence and potentially even buying them if it meets the criteria you're looking for. If you aren't subscribed to my page, make sure to hit that subscribe button below, crush the like button so that as many people as possible are able to see these videos. Leave a comment with your thoughts, whether you agree or disagree, any questions you might have. Additionally, please sign up for my Patreon. You'll get insight into my watch list, which includes SPACs, my portfolio, live updates on different stocks that I'm thinking of investing in based on my daily readings. And these include many different SPACs that are announced, whether they go initially public or they're announced a merger or they're getting ready to close out the reverse merger, and instant posts about my stocks and buys as they're happening each day. So make sure to sign up, and here we go. We'll be going over now how SPACs work, what they are, the process of SPACs, the timeline the SPAC goes through, what the structure of the SPAC is. So first, we'll go over the structure of a SPAC. So first and foremost, there's a sponsoring company, or in this case, it's called a parent company. As an example, Social Capital, which is Chamath's firm, is a sponsoring company or parent company, and it sponsors the specific SPAC. So an example would be IPOD or IPOC. That would be the special purpose company. The special purpose company will have an IPO. This IPO is usually a lot quicker and easier than most IPOs because the special purpose company is just formed. So the financials are very simple. The disclosures are simple compared to an actual operating company or a business that actually had business or financials over the past few years, where you actually have to audit those financials from the prior years and make sure that they meet up to the standards that the SEC requires before reporting the 10Qs or 10Ks or their S1. So the special purpose company will then go IPO. The IPO will have portions of the parent company's funds as well as additional funds from investors that invest in the IPO, whether that's institutional funds. In many cases, this might be commitments from different companies, and whether it's the BMWs of the world, the Googles of the world, etc. They might invest in it. And then obviously there's some retail investors that also will invest in the IPO once it goes public and it hits the market, and those original investors might sell some of their shares, and then there might just be some shares available for individual investors to invest in the company once it goes public. The company will IPO at a share price of $10 per share. That's the standard. There are a few exceptions. An example is Bill Ackman's SPAC, PSTH, IPO'd at $20 a share, which is an anomaly and an exception. Generally, most, if not all, SPACs will IPO at $10 a share. And basically, that's the book value of the SPAC. The SPAC is worth $10 a share with all the money that's in the SPAC. So generally, the SPAC will never trade below $10. If it is trading below $10, it'll be in the high 9 range. It'll basically be close to that $10 per share, because if the SPAC does not close on a target in the 2 years that it has, then that $10 a share is guaranteed plus interest back to you when the SPAC basically is extinguished and they weren't able to actually acquire a target. So the special purpose company is looking in that 2-year time span to find a target company that they can buy, whether that's an IPOC, for example, was Clover Health. That's who they acquired. An IPOB case, that was Open Door. And then there's been many other SPACs as well, like TRNE, which acquired Desktop Metal, which I've talked about on this page. And some of the other ones that I've had in Tattooed Chef. There's many other SPACs that have happened. It's gone very popular and it's become a very popular vehicle. So basically, they have 2 months to be able to acquire the target company. Here we'll go into a little bit more detail about each of the phases. So the IPO phase takes about 8 weeks. Sometimes the ticker will get assigned and they have to go through audit. They engage counsel and auditors. They incorporate the SPAC, sell founder shares to the parent company as well as maybe some of the initial investors in the SPAC. They prepare the S1, which is the filing to be able to go public. They prepare it, and then they file the S1 along with any amendments that the SEC requires in addressing some of the comments, which takes about 6 weeks. They negotiate underwriting with the investment banks, and then finally they go out and do a roadshow to be able to get additional investors and make sure to get commitments for the IPO so that the shares can go public. Next phase of the SPAC process is the target search and negotiation phase. Here, the sponsors of the SPAC, in this case Social Capital, will be looking to negotiate or find potential targets. In many cases, they have many targets in mind, and they'll start going and pursuing potential targets, trying to negotiate with them, trying to get the price point that they want. They already have probably a list of target companies that they're looking for, so they're approaching each of them and seeing which one makes the most sense, and seeing if they can get the negotiating terms that they would like. They just have to do SEC filings at that point. Over the 19 months that they have or so, they have to do 10Qs and 10Ks, reporting basically their operations. But in most cases, all they're doing is maybe paying a couple of employees who are looking for the target companies, and for the most part, probably just investing the money in low risk securities in order to be able to just generate some interest or be able to generate some gains. So they're identifying target businesses, conducting due diligence and negotiating acquisition agreements, potentially arrange for additional money from other companies or individuals or investors, which is called a PIPE. Basically, it's an additional amount of money that the sponsor is able to generate from other companies or investors or funds in order to be able to bring more cash to the target company. Finally, it's the last phase of signing the acquisition agreement and creating the finance commitments to the target company. This is where the target company then gets announced to the public that the reverse merge is happening. They've signed an agreement. Obviously, things could break down. The shareholders could not approve the merger, whether it's the shareholders of the SPAC itself or the shareholders of the target company. So once the approval is announced, they announce the acquisition agreement. They file preliminary proxy and an offer for the acquisition of the company. They meet with the SPAC investors to discuss the transaction, which are the investors in the IPO or the SPAC. And then they get approval from the shareholders of the SPAC, renegotiating the transaction or addressing any issues or comments that they might have. We'll be going through the decision tree now as far as what happens with a SPAC, what decisions have to be made, just a different way of looking at it. Here we can see the IPO date starts. So the SPAC has been formed. It's gone public. Now investors are able to invest in it. Likely it's close to $10 a share at this point, unless it's a popular SPAC by a popular investor or a fund or a firm. So for example, now Chamath or Social Capital's SPACs usually get a lot of popularity, and on the first day they're trading, they go up to $12 or $13 per share from an initial $10 per share. But some of the less popular SPACs or less known SPACs will stay at $10 a share, and some even Chamath or Social Capital's SPACs will come back down to $10 a share until a merger or target is announced. So IPO date happens, SPAC starts looking for acquisition targets, and then so they're basically doing their due diligence like we had explained before. either a target is announced or no target is found. So let's go through with the scenario where no target is found. If no target is found, the SPAC basically just liquidates, especially if they've gone through the 19 months or about 2 years. The SPAC liquidates. It gives everybody $10 a share plus interest. So basically, if you've invested close to $10 a share, you almost lose nothing. But the biggest cost is going to be the opportunity cost, because you could have put your money in something else in those situations. So you always want to make sure you're putting your money in a SPAC where the fund or the sponsor or the parent company has a proven track record of closing deals. Next, if the target is announced, SPAC works to complete the transaction. They work with the shareholders to vote on the proposed business combination. If the shareholders vote no, if shareholders voting no, they can redeem their shares for the pro rata value. So usually it's $10 plus interest, similar to if there was no target. And in many cases, if you invest in a SPAC, you get an email saying, would you like to sell your shares for $10 plus interest? And in those cases, you vote no, because the SPAC is probably trading a lot higher than $10 per share at that point. Shareholders will vote. Acquisition is approved and completed. Acquisition completed phase, or acquisition could be rejected or withdrawn. In that case, again, the SPAC liquidates, especially if it's at the 2-year mark, or they can potentially find another target. If the acquisition approved by both shareholders, the merged company commences trading, and then warrants could potentially become exercisable. So another question many people will ask is shares versus warrants, because we just came to it. So the SPAC, when it goes public, it initially will be traded as a unit, and the unit in most cases will give you a right to 1 share of the SPAC in addition to 1/4 of a warrant. So each 4 units that you own, or each 4 units that you buy of the SPAC at $10 a share, will give you 1 warrant, and that warrant gives you the ability to, when you exercise it, it gives you the ability to redeem 1 share of the stock at an exercise price of $11.50 typically. In those exception cases, it might be $22 or $23 for PSTH, for example. So $11.50. So you're going to exercise that warrant if the price of the share is above $11.50. The company could redeem those warrants at a certain point. Basically, they want to redeem all the warrants because they want the cash, additional cash related to those warrants, because you have to pay that $11.50 to exercise the warrant. So they will redeem all the warrants potentially. And in some cases, they might just let the warrants, leave the warrants out there, and then the individual investors have up to 10 years to exercise those warrants. So that's a quick overview of the warrants. That was all we were able to get through today, unfortunately. Next time, we'll be going through the last 2 items that we mentioned, why SPACs are a good investment, as well as any questions you all might have, and my recommendations for SPACs to look out for. If you're looking for SPAC sooner, make sure to sign up for my Patreon, which is in the description below. As always, make money, enjoy life, peace.